Hi, a very good evening to every one of you. Thank you for joining us here at the day one of our Phillip Nova Young Investors Trading Challenge Bootcamp. Okay, my name is Junkit and I will be your MC for today. Okay, so the title for today's webinar would be Introduction to FX and CFD Trading, conducted by professional trading coach Kar Yong. Okay, so I think without further ado, let's get the ball rolling. Before we start this session, it's important that we make this disclaimer that whatever that will be conducted or whatever that will be conveyed during this session is only for educational purposes only. It does not constitute any investment advice because we are unable to ascertain your personal financial situation, investment objectives, and risk appetite. So we do hope that you are able to benefit from this session, and these are all for educational purposes only. Okay, so the session for today, this is the outline. At the start, I would be doing a short briefing on this trading challenge that you are signing up for. Secondly, I would pass the time on to Kar Yong to talk to you more about the fundamentals and technicals of Forex and CFD trading. And also lastly, we do hope that you can stay with us until this very last part where we would announce to you an exclusive perk that you'll be able to enjoy from this trading challenge. All right, so a brief introduction to our trading challenge. So the Phillip Nova Young Investors Trading Challenge 2022 aims to provide you with the platforms, to hone your trading skills and to put it up against friendly competition and stand to win the top prize of $1,000. Okay, so during this competition, which would begin from 29 August 5 a.m. SGT, which is next Monday 5 a.m. SGT, all the way to 9 September 12 p.m. Singapore time. So during this trading period time, you would be trading Forex and CFDs in a demo environment that you have signed up and registered for with a paper money of 100,000 US dollars. Okay, so at the end of this trading period, the top 23 winners would be entitled to something. So the first prize, you'll be walking home with $1,000 Singapore dollars. The second prize would be $500, and then the third prize would be $300. And then the good news is, to benefit more of you, we would also be awarding those who are ranked between 4th to 23 with a trading credits of $50 that will be deposited straight into your trading account. Okay, and this is the important timeline of this trading challenge that you should take note of. So today is the first day of the introductory bootcamp, and secondly, tomorrow we'll be having the day 2 of the trading bootcamp. So today we cover mostly on the fundamentals of the product. Tomorrow we would be sharing with you on formulating a trading plan and also how to actually use this trading platform that you will use for this trading challenge. All right, and also starting from tomorrow and on Friday, we would be resetting your trading account because you guys have registered for the trading account. You guys may have placed some test trades on it. So from tomorrow to Friday, we will be resetting all of your accounts. Okay, and then trading will be disabled until next Monday, where the trading challenge will start. Okay, trading challenge starts on 29 August all the way until 9 September, where we would stop and disable trading for everybody at 12 p.m. Singapore time. Okay, and by 14th of September, you'd be able to know who are the final winners. All right, so throughout the trading challenge, I mean, the good news is you are able to see your progress and to see how you stack up against other competitors by following our Instagram page, where we would be updating on a daily basis the top 10 leaderboard. Okay, so at this time, we would encourage you to scan this QR code on your screen to follow our Phillip Nova Instagram page. Okay, so I think for now, we would give everybody 15 seconds to do this so that you're able to see your progress and the leadership throughout this trading challenge. Okay. Okay. If you are not able to follow it now, you may still refer to the emails that we sent to you. There should be a link that would direct you to our Instagram page. Okay, so at this point, we want to make an announcement on an administrative matter. From now until tomorrow, if you wish to use this demo account to play some test trades, do note that you are to log in to this server called Phillip Futures/demo. Okay, But on this Saturday, 12 p.m., we would be changing this server name to Phillip Nova Demo. Okay, so for those of you who have logged in to Phillip Futures Demo up to today or tomorrow, on Saturday, you would have to re-log in to this Phillip Nova Demo server with the credentials issued to you at your email upon signing up. Okay, and if you require any assistance during this time to reset the password, you may feel free to reach out to us via this email that is displayed on your screen. Okay, also for desktop application users, the installation of the reinstallation of the new installer over your existing Phillip MT5 is required after Saturday, for the correct servers to display. Okay, so I think that is it. Next up, I think I'd like to introduce the speaker of today. His name is Mr. Kar Yong, and he actually started trading at the age of just 21, okay, with a small capital of 500 US dollars. And after just 2 years of Forex trading, he was able to increase his capital by 2,600%, which is crazy. Okay, and since then, Kar Yong has been featured on Channel News Asia Money Mine, awarded the most popular FX trainer in Malaysia, and then also the top Forex analyst in Asia by WikiFX in 2019. And having coached hundreds of traders across Southeast Asia, Kar Yong believes that anyone with the desire and the right mentality can succeed in trading. Okay, so at this point, I'd like to warmly welcome our speaker of today, Kar Yong.
All right. Okay. Good afternoon, everyone. I think my webcam and audio should be working at the same time. I believe you're able to see my screen as well.
Yes, we are.
Okay. Cool. Okay. So I'll get started with that. So great. Once again, would like to thank Phillip Nova for having me to be here with, giving me this opportunity, right, to share with you guys what I know, what I've learned from the market. And hopefully through this session, I'll be able to also inspire you to eventually become a trader yourself. Okay, and of course, to give you some insights of how you can actually prepare and potentially also, emerge as a winner in this little competition over here. Okay, I prepared quite a bit of content, and I'm pretty sure that as we progress, you might have some questions along the way. So what I would strongly suggest is do write those questions down, because I would rather, finish off the presentation first so that it's flowing. And then we'll have a Q&A segment where you'll be having some time where you can ask questions and I'll be able to answer them as much as I can. Okay, so why I encourage you to write it down is so that you don't forget what you want to ask, right, by the end of the session, and you might have more than one, right? So strongly suggest you to just note it down, and during the Q&A, you can actually put up the questions in the chat box or Q&A segment, and then I'll be able to look at it. Cool. So with that, okay, let's get started. Today I'm going to share with you mainly on three parts of the presentation over here. Okay, we're going to talk about fundamental analysis, giving you a good introduction about how you use the fundamentals to analyze the market. We're going to talk also about technical analysis, how you can use charts to help you decipher, whether you want to be buying or selling, how you can execute a trade. And eventually we're gonna put them together, share with you a little bit on the risk management aspect, okay, which is very, very important for every trader here to have that knowledge and the ability to manage your risk, okay, and you want to then apply all this principle into your actual trading as well as the challenge that you guys are participating right now. Good. Okay, so today's objective over here, we're going to cover on managing your risk, understanding fundamentals and technical, and of course, how to use this two methods to analyze the market to conclude, right? Reach a conclusion on whether you want to be buying a trade, selling a trade, on how to execute them. Okay. And last but not least, once you actually acquire all this, you can put them together and what we call develop your trading plan, right? Your strategy to approach the market. Okay. So very quickly, 1 minute introduction about myself so that you guys know who am I. So my name is Kar Yong. I started trading back in June 2012. That's my very first exposure into the currency market, the FX market. So I started with a small amount, right, in the live market environment, and very quickly I was able to make a good money, right? I was able to double my account in less than 3 months. But the fourth month, I actually lost everything, okay, including my capital, and that's where I start to realize that you're able to make money from the market, but at the same time, you can lose money fairly quickly, right? So that's the part where I got really excited about what exactly this financial market is, and I wanted to dive deeper and study, exactly what is it, how to make money, how to protect my profits, control my losses and things like that. So that's where I got started. Okay, throughout my journey of learning how to trade, I've actually tried out very different methods. Whether some of you are very new or some of you who are experienced, you might also come across different ways, okay, to approach the market. Whether is it from a fundamental point of view or from a technical point of view, where you have like various indicators, okay. So what I want to share with you over here is also to let you know, coming from my personal experience where I've tried out many, don't waste too much time trying to find like the perfect method, okay, or what we call the holy grail, because there's no such thing, okay. There's no like 100% winning strategy out there. Every method, every type of analysis, whether is it fundamental or technical, has its own strength and weaknesses, okay. So as a trader, you need to go and try out different methods to eventually find one that you are aligned with, okay, which means your personality, your style, you want it to be aligned with the technique that you're using to analyze and trade the market, okay, and that to you becomes your quote unquote holy grail, okay. And one of the biggest mistake I've learned in the market is I blew off a $20,000 account, okay. It's not a small amount, okay, but of course if you look at it, it's not a very huge amount as well, okay. But that was the lesson that I learned about risk management, okay. And every time I have opportunities to share what I've learned and my experience trading the market with fellow traders, I really enjoy it, right? Because I hope to achieve where you can learn from my lessons directly, so that you don't need to go through those painful lessons, okay. So it's good also that you guys are participating in this challenge, because it's in a very safe environment where you're not risking your actual money. But I want to encourage you guys to take this challenge very, very seriously as well. And don't think of it as, oh, it's virtual and there's no risk involved, okay? If you're approaching with that kind of mentality, then when you approach the live market with your real money, real account, it's not going to benefit you, right? So this is something that risk management, I keep emphasizing, is very important for all traders, okay? I turned full-time in 2015 by the end of it, okay. So end of 2015, early 2016, that's where I've transited to doing this full-time, okay, trading and investing in the market. And to date, I would say, this is a journey that I've never regretted, really enjoyed it, okay. And I definitely foresee I'm gonna do this forever, right? And one thing I truly enjoy on top of just trading and investing is to share what I know, what I've learned, my experience with fellow traders and investors like yourself, right, in today's opportunity over here. Cool. Okay, so that's a very quick one about me. Very quickly, just to share with you some photos in the past, where before the whole COVID pandemic thing, we did a lot of physical events, which I truly enjoy. But because of that, right now, a lot of us are transiting into virtual online event. Okay, there's definitely a difference, right? I mean, right now, what I can do is I only speak in front of my screen. I can't see you. I can't see your expression. I don't know if you're following me, you're getting me. Maybe you're not paying attention, right? I don't know. Okay, but what I can do is right now is just continue speaking. Okay, so very, very different from physical event, because during physical event I can really see whether you guys get it or not, and if you don't get it, I can repeat in a certain way to make sure that you guys get the most out of it. Okay, so that's why I really encourage you to, number one, be attentive, be present in today's sharing. Number two, be active in the part where if you have questions that pop up, okay, that you would like to clarify, do write it down, okay, because the last thing you want is you forget what you wanted to ask, and maybe that was a very, very important question that might impact your trading performance in the future, right? So again, strongly encourage you guys to be active, be present, okay? And if you have any questions, write it down. Good. So now with that, we'll jump into the very first section of today's sharing over here, which is to understand the fundamental of the currency market, right? In terms of FX, okay? So we use the word Forex, FX, currency quite interchangeably. Now, when we talk about this, sometimes I get the feedback from traders is like, oh, but I did not study economics in school, right? Is it still applicable to me? Is it going to be very challenging? Is it going to be difficult? My answer to that is no, right? I did not major in economics, okay? But you can still apply fundamental, okay? And my role here today, you know, sharing with you is to actually simplify that whole concept so that you understand it and you can apply it, right? So that's my role as a coach, as a presenter today. Okay, so I want you to be open-minded, okay, and just be willing to accept as much information as you can within today's session. Okay, and there's another school of thought where, you know, if you have some experience in trading, some traders would say fundamental not important, right? Because you don't need it. All you need is the charts, the technical aspect of it. They are not entirely wrong, but they're not entirely right as well, okay? Because as I mentioned, every method has its unique strength and of course weaknesses. Now, if today you don't understand fundamentals and you approach the market, it's just like you don't understand something, but you're still doing it, okay? So fundamental is actually important in giving you an understanding of how the market actually functions. Okay, and in today's context, where if you're aware, we have high inflation globally, okay, and we have interest rate around the world rising. Okay, I'm pretty sure if today you're based in Singapore, you're also feeling the impact of inflation. Causes and prices are going up, right? So from a fundamental point of view, if you understand how the market works, you actually can capitalize on this opportunity as well. Okay, so it has its strength. Right. So with that, let's dive deeper into what fundamental analysis really is. Okay. So fundamental flow over here, whenever I do share it, I like to break it down into big picture, right, where you can understand the entire flow of it, and then we dive into the details, right? So fundamental flow over here, if today you want to approach fundamental analysis and understand it, there are generally three major components that you want to take note of. Okay, so the first component over here is central banks. Every country would have its central bank. Okay, so if you're based in Singapore, I think you know MAS, right, Monetary Authority of Singapore. In Malaysia, we have the Bank Negara. Okay, and of course, if you're talking about currency market, you trade the major currencies like the US, we have the Federal Reserve, the Euro, we have the European Central Bank, in short, ECB, right? So every country would have a central bank. Now, to approach fundamental analysis, you need to first also understand like what is the function, what is the role of a central bank, okay? And we're going to dive deeper into that. We're going to talk about what are the tools that the central bank can actually utilize to kind of control, okay, how the economy is developing. Okay, for example, like right now we have high inflation, right? What would the central bank do in order to prevent hyperinflation? Okay, and then there are some discussion about will we see a potential recession next year? If it is, what is the central bank going to do? Okay, so from that perspective, you have a better understanding of how it's going to impact the economy. Okay, the second component, of course, is to understand the various economic indicators that has an impact to the central bank, right? So economic indicators are like your report card, okay? It's telling the central banks how the economy is performing, right? So for example, if we say right now the inflation is very high, okay, how do we gauge whether inflation is high or not? Okay, we need to then refer back to the economic indicators, right? Economic indicators tells you that, oh, right now inflation is high, right? So therefore the bank needs to do something to curb hyperinflation or prevent hyperinflation, right? So economic indicators are like your report card, So as a trader, you also need to understand how to read these indicators, because it's going to give you what we call a forward guidance as to what the banks are likely going to do. Okay, and the last component of this is, of course, to make sense of it, right? Understanding how this entire fundamental flow is going to affect the market. Okay, and as a trader, how can you capitalize on it? Okay, how can you kind of project in the future what is likely going to happen? Is it going to strengthen? Is it going to weaken? How can you take a trade and make money out of it? Okay, so those are the fundamental flow. Now, to dive into the first component of the central bank, I will flash over here total of 8 major currencies and therefore 8 major central banks. Okay, we don't trade all currencies around the world, right? And as an FX trader, you're probably going to focus more on 8 major pairs or 8 major currencies, and these are the 8s. Okay, you have the dollar, which means that the central bank that deals with the dollar in the US is called the Federal Reserve. You need to be familiar with the name as well. Then we have the yen, the Japanese yen, which is Bank of Japan. Okay, in short, we call it BOJ. Okay, and then of course, subsequently, I think you can read down the list, right? Bank of England, in short, is called BOE. European Central Bank, in short, is ECB. Swiss National Bank, in short, is SNB, right? Basically, we're taking like the first letter of it. Okay, RBNZ is Reserve Bank of New Zealand, RBA is Reserve Bank of Australia, and Bank of Canada is BOC. Okay, you want to be familiar with the name and the acronym of it, because as we communicate as traders, usually we just say ECB, right? You need to know, oh, okay, that's European Central Bank. We are talking about the euro. Okay, and the Federal Reserve here is called the Fed, FED, right? So be familiar with all these terms. Okay, now once you are aware of all these different banks, the next step for you to be aware of is what is the mandate. Okay, mandate is a very big fanciful word, but it basically stands for Key Performance Index, KPI, right? Or you can think about it as what is the goal of central banks, right? What do they need to achieve? What do they want to achieve? Now, for most developed countries, there are 2 things that they aim for. One is what I call price stability, or you can call it AKA inflation target. Okay, now what is price stability and why is it important? Okay, so put it in terms of your day-to-day basis application, right? If today you go down the street, you want to maybe buy a cup of, taping tea, right? Maybe in Singapore, back then, if I still recall, maybe about $2 or less than that. Okay, maybe about 180. You can get a cup of taping, right, or a cup of tea. Okay. Imagine the next day, the following day, you go back to the same store, you order the same cup of tea. Right now it's at 250. Okay, how are you gonna feel, right? You're gonna feel like, wow, panic. Okay, what happened? How come suddenly so expensive? Okay, and then if let's say 2 days later, right, you go back to the same store, order the same drink, and then right now the same cup of tea becomes $3, then you'll be even worse off, right? You'll be like, wow, this is crazy. Okay, and that's what we call inflation, or even to the extent of hyperinflation, where there is no stability of pricing anymore. Okay, and that would cause panic and fear within the economy, right? Everyone would start to be afraid. Okay, so the bank needs to prevent that from happening, and they need to ensure that prices in the economy are stable. Okay, stable doesn't mean stagnant. Stable means generally they want to, of course, see some growth in the economy, but not too fast, not too slow, right? So that's what we mean by stability. And most common kind of number or objective that central banks would have is inflation rate targets. Okay, and this is good knowledge for you guys as well. Every central bank that is in, developed country central bank has a range of about 2 to 3% annual inflation target. Okay, so what this means is that they are expecting, or they want to ensure that the economy is growing by about 2 to 3% on an annual basis. Okay, So this is also good for you to know, because if today inflation rate is too high, which is above 2-3% on an annual basis, you will know that, okay, the bank needs to step in. They need to do something about it. Vice versa, right? If the inflation rate on an annual basis is like significantly lower than 2%, maybe at 0%, then you know, okay, the bank would then need to step in as well. Okay, so this is kind of like the metric in which you need to know whether the bank needs to do something to bring it down or bring it up, right? And in today's context, we know, okay, global inflation is high. Some of the discussion that we had was next year, perhaps inflation might be in double digit, which is very scary, okay? Because if you take a look at oil prices, petrol prices, okay, it's affecting everyone. Okay, so inflation too high is not good, right? So that's something you need to know in terms of central bank mandate, the first target. Okay, the second is unemployment rate. Okay, so as a central bank, they need to also ensure that the economy has a certain capacity, and the way to measure that is through employment rate. Okay, so most central banks will want to achieve what we call full employment, which means that generally people who wants to find jobs are able to do that. Okay, full employment doesn't mean 0% unemployment. Okay, because there are other forms of an unemployment rate which is structural or seasonal. Okay, which means for example, right, some jobs are only available during winter season. Then naturally, if it's not in the winter season, these people that's working in that industry will be out of jobs, right? So we're never going to get zero unemployment rate. But if today the unemployment rate drops below 5%, that's already considered full employment from a central bank's perspective. Okay, so if unemployment rate is more than 5%, they will need to start to think of ways to bring it down. Okay, so those are the two main common targets that developed countries would have. If today you're based in Singapore, I think you will also know that MAS has an additional target. Okay, we call the currency bandwidth, where they want to also ensure the Singapore dollars maintain within a certain range, so that when your imports come in, it's not going to be so expensive, right? So these are more unique to certain countries where they are heavily reliant on imports. Okay, their currency cannot be too weak, or else the imported prices will be super expensive, and is then also going to slowly trickle down where inflation rate within that country is going to shoot up. Okay, so Singapore is unique, right? So Singapore MAS would have a third mandate where they need to ensure that the Singapore dollar falls within a certain bandwidth, right? So this is good knowledge for you guys to know, and of course, as traders, okay, you also want to know all this information. Now, from understanding what are the central banks to the function and the KPI, the objective that central bank aims to achieve, the next part over here is to put that into perspective of like, what does it mean to you? Okay, so if the economy is too strong, or aka what we meant by inflation rate too high, okay, the banks need to step in, as I mentioned, to prevent hyperinflation. The opposite is if the economy is too weak. For example, like just 2 years back or even 1 year back, we have COVID, and then globally every country shuts down, right? Prevent limits supply, limits manufacturing, prevent traveling. So that kind of cut down on a lot of production. And globally, the economy actually fall into a temporary recession back then. Okay, and the central bank actually step in and take very, very fast action on that to prevent, globally we go into a recession. Okay, so same thing over here. I want you to understand that if it's too good, it's actually not good. If it's too bad, it's also not good, right? So what's ideal is actually a balanced growth, okay? And that's what the bank wants to achieve. All right. So what are the tools that they can actually utilize to, play around with this condition? If it's too good, to bring it down a little bit. If it's weak, to bring it up a little bit. Okay. Generally, there are 3 types of tools that they can utilize. Now, the first one here is interest rate. Okay, I think this one here is one of the most common one that you might be also aware already, because globally right now, every country is probably looking at increasing rates except for a few. Okay, and interest rate over here, if you put yourself in the perspective of a kind of like buyer, right, or a business owner, okay, how does it impact you is that when today you want to buy something that is maybe of a certain high value asset, okay, or if today you run a business and you would like to take a loan to expand your business, interest rate comes in as a very important factor, okay, because if interest rate is high, what will happen? You will be reconsidering whether you want to take the loan, okay, and that itself would eventually trickle down and have an impact into the economy, because if businesses spend less, the economy will not grow as fast, and eventually people spend less, the economy starts to pull back. Okay, so it starts to slow down a little bit. So that's where it has an impact on it. Okay, the opposite is true, right? If interest rate is low, businesses would be more willing to borrow and take a loan and expand aggressively, right? And when more spending incurs, economy starts to grow, inflation hits back up. Okay, so that's the whole idea of interest rate. The other one that the bank can do is related to monetary policy, and that is where the quantitative easing, or in short QE, comes in. Okay, so what is QE? You can see it as printing money. Okay, of course, from an economic perspective, it's not just about printing money and then distributing the money, but the understanding here is money supply. Okay, if there are more money supplying in the economy, people are more willing to spend, right? And when there's more spending, it pushes up the economy, right? Vice versa, if the bank feels that the interest, the inflation is too high, okay, and what they were going to do is they're going to cut down on the money printing process. Okay, so less money is being introduced to the economy. Less money supply, people spend less, money becomes more expensive, more valuable, spending drops, and therefore inflation would eventually be coming down as well. Okay, so that's where the relationship comes in. Okay, the last tool over here for you to understand is what we call language. Okay, so central banks can utilize this technique to also have an influence in the market. So for example, a president or a chairman of a central bank can come, can conduct a press conference and say that, oh, based on this current economy state, in the future, this is what we're going to do. Now, when they say something like that, it will have a direct impact in the market, because people would believe that that's what they're likely going to do, even before they actually do it. Okay, so for example, if the Fed announces that, all right, we're likely going to increase rates 2 more times in this year, the market would start to already digest the information and say, okay, the Fed is hiking 2 more times, but they have yet to hike it, right? So language is actually a very powerful tool that the central bank can use to influence the market. Okay, so have in mind, these are the 3 tools that the bank can use. Okay, sometimes they will use one of it, sometimes they'll use all 3 of it concurrently. Okay, so that's the bank part. And how do you know about all this information? Okay, so as a trader, you need to maintain, or I would say you need to keep yourself updated as to what's happening right now, right? So central bank meetings are important. Later I'll share with you roughly, how you can prepare yourself, where you can find all this information online that is freely available. Okay, so you want to take note that every bank, generally, they're going to conduct what we call a meeting about every 5 to 6 weeks on average. Sometimes it's a bit more frequent, sometimes it's a bit less frequent, depending on the state of the economy. But generally, it's about 1.5 months, right? They're going to have a meeting, and during this meeting is where they're going to announce and inform the market what they are going to do. So as a trader, you need to take note of that, right? You need to keep yourself updated, because it's going to impact the market, and there are some opportunities you can actually leverage on. Okay, so over here, to kind of sum up a little bit Okay, if today's interest rate starts to increase, there's a good tendency that that specific currency tends to strengthen. Okay, so if the Fed is hiking, then the dollar is likely going to strengthen, which we are seeing it right now in 2022, right? The dollar has strengthened significantly. If the bank starts to cut rate, okay, or relative terms, if one bank increase rates, the other bank is not, then this bank that did not increase rate relatively is weaker. Okay, so that particular currency tends to weaken as well. Okay, and if the bank holds rate, then it's a little bit more uncertain from a fundamental point of view because it can move in either direction. Okay, I do have this little flow chart here for those of you who are interested. This can sum up what I've just discussed in a diagram. Okay, how to read this? You start it from the top left where the better economy, right? So if today the economy is good, we have high employment rate, people have jobs, they have more income, they're going to spend more. Okay, inflation is going to go up because of spending, because of demand. And then there's this fear of overspending and hyperinflation. The bank will kick in, will step in and start to increase rates, right? And when that happens, that particular currency tends to appreciate. And what will happen next is people spend less, right? Because interest is higher right now. Okay, and when that happens, people spend less, demand drops, economy pulls back, and then you have this cycle of, what if we go into a recession? Okay, and then the bank will kick in again, and they would start to drop rates to prevent recession, and the whole cycle repeats, right? And that's the part where you realize, how come every about 8 to 10 years we get a recession? Okay, it's really because of this cycle. Okay, so understanding all these aspects from a fundamental point of view can give you a confidence to approach the market, to give you that clarity of what exactly moves the market, okay, and not just your price chart, but back end from a fundamental point of view, there are some forces that are affecting your currency market. Okay, this is another summary table to put things into very summarized version. When the economy is bad, the central banks would take certain action, and then the effect that it has on the particular currency, and vice versa. If the economy is strong, what would the central bank do, and what is the effect of the particular currency? Okay, now at this point in time, I want to just let you know that this is not so straightforward in a way where 1 + 1 = 2. Okay, that's not how it works in the financial market. Okay, because a lot of times people will say, oh, if economy is good, the currency will therefore goes up. Okay, if the economy is bad, therefore the currency will drop. Not so straightforward, right? It's not like 1 + 1 you always get 2. If it's so straightforward, everyone would have been making money in the market. Okay, this aspect here is what we call is one of the factors that can affect the price movement in the market. Okay, but you also need to be aware that in the financial market, there are a lot of different factors coming in that has an impact, right? And it will affect the movement of price. It's not just one direct factor, but fundamental is one of it. Okay, so if let's say you have like 3 forces, okay, fundamental is one of it. So do have that in mind as well, right? As you are utilizing fundamental analysis to kind of look into the market, understand that it's not just this that is going to move the market, okay? But it has a role to play, okay? So hope that helps. Let me quickly show you one of the websites, that's freely available where you can study a little bit more in the various economic indicators. It's called Forexfactory.com. There are multiple sources out online that is available and it's free. Forexfactory is just one of the more common ones for us as FX traders, right? You might also be aware that you have like Forex Street, okay? But for me, they're more or less the same, right? So it's just a matter of personal preference. Which one do you prefer to look at? Because the data, they are the same, okay? So this is where we transit into the economic data, economic indicators, right? Now that you understand the role of the banks, you understand what they need to do in certain situation. The next component over here is more of how do we know what situation we are in right now, okay? So that's where you need to understand a little bit on the economic indicators component, okay? Now you don't need to go and study all the hundreds economic indicators available out there, but at least understand and be aware of a couple of few that are more important. Just name a few for you, right? Unemployment rate, okay, it's an important data, right? And I think most of you would already understand like what unemployment means, okay? Then you have, CPI stands for Consumer Price Index, okay? So basically that indicator kind of tracks, what are the prices in, general goods and services, right? And that itself is what we call an inflationary data. Okay, so it kind of tracks inflation. Okay, so at the end of the day, what are the two categories of indicators that are important? Something that deals with unemployment, which is your labor market. Okay, and the second category is anything that deals with inflation is going to be important, right? Why? Because the banks are looking at this too. They have this two target over here, and therefore you as a trader, when you look at the economic indicators, these two categories are always the most important one. Okay. So let me bring you to, this is Forexfactory. Under the calendar tab, you can actually see, from a week to week basis, what are some of the economic indicators that are about to release. Okay. For example, right, let's put things into context. Today, or was it this week, okay, not today, this week over here, we have one upcoming on Thursday, which is tomorrow at 8:30 p.m. We have this data from the US coming in called the prelim GDP Q on Q, quarter on quarter. Okay, and I think right? GDP is basically a good measurement of how the economy is growing overall. Okay, and you want to keep track of such indicators because if, let's say, okay, tomorrow's data on prelim GDP comes out as very negative, very bad. So it kind of tells you that, okay, the economy is getting worse, okay? And from that whole chain of thought, you start to think, okay, if the economy is getting worse, are we going to go into a recession? If you're going to go into a recession, what will the central bank needs to do, right? So from there, you start to have this link, right? The whole understanding of what we just talked about it, okay? And if the bank is going to come in to prevent recession, what are the tools they're going to do, right? What are the tools they're going to use? And when they utilize certain of these tools, how is it going to impact the currency market? Okay, so that's where all this starts to build in. Okay, same thing, the next indicator you can see on Friday at 8:30 here, we have the core PCE price index. So if today you're very, very new to this indicators, this kind of principles and concepts, right? There is some tip to help you, right? So if you go over to Forexfactory, you have this little folder here where you can click, okay, where it expands, and you can understand a little bit as to what this indicator does, right? So core PCE price index measures the change in prices of goods and services purchased by consumer, excluding food and energy. Okay, so it basically just tells you what this indicators track. And then you also have this component on why the traders care. Okay, because this is the Fed's primary inflation measure, right? So if the Fed put a lot of importance on inflation, and this core PCE price index is one of the indicators to measure inflation, then it's important. Okay, and therefore how this data is going to be releasing on Friday is going to have a direct impact on the dollar. Okay, because if core PCE price index comes in very, very hot, very positive, what does it mean? Inflation is still there, and when inflation is high, what will the bank do? How is it going to have an impact in the currency market? Okay, vice versa, if core PCE price index on Friday comes in very bad, okay, so when we know, okay, inflation is not that serious anymore, maybe the bank doesn't need to be so aggressive in increasing rates, then that will also have an impact in the dollar, right? So that's the idea of understanding economic indicators, put it into the perspective of a central bank. How is it going to impact their decision and the tools that they're going to use, and then you put it back into what it means to you as a trader. Is it a buy trade opportunity or is it a sell trade opportunity? Okay, so far, hopefully so far you guys are getting it right, and you can see where this whole fundamental thought process comes in. Okay, very quickly, just to also bring your attention to the part where the application of fundamental here is you want to pair, okay, a strong fundamental currency with a weak fundamental currency, right? So we are talking about relative terms over here, right? Give you some context as of right now, okay? So we have the 8 major central banks, right? Let me just bring back this portion of the slides where this 8 major central banks, okay? There are a couple of central banks that are right now, I would say, hawkish, right? The term we use, hawkish, is equivalent to what we mean by bullish or strong, okay? That means they're basically in a cycle of increasing rates and tightening. Tightening means that they're not printing too much money, okay? So that means good, right? Economy is good, they are hawkish. Okay, so there are a couple of banks right now, they're in a hiking process. Okay, this includes the Fed. Let me change the color. Okay, this includes the Fed, which is hawkish. Okay, this includes the Bank of England, which is hawkish. This includes RBNZ, RBA, and the Bank of Canada, right? So you know, generally in today's context, this couple of banks are increasing rates, and therefore, generally speaking, these currencies are going to be generally stronger, okay? Relative to what? Relative to Bank of Japan, which is the yen, relative to ECB, which is euro, and Swiss National Bank. Okay, now why is that the case? Because Bank of Japan, as of today, is still not hiking yet. Okay, when most of the banks are already increasing rates, the Bank of Japan is not. Okay, European Central Bank just recently started to do hiking. Okay, but it's slower as compared to other banks, right? So if you put it in terms of a scale, in terms of a scale like that, if this is where it's very, very positive, this is very, very negative. Japan would be probably at the bottom of the scale. Okay, Euro would probably be somewhere here. But some of the banks have already been hiking a couple of times since this year. For example, like the Fed is definitely almost at the extreme of the hiking scale. Okay, same to Bank of Canada, Bank of England, etc. Okay, so when you have this perspective, right, you can actually pair two currencies together, and from a fundamental point of view, you get a very clear sense of direction. Okay, so if you take a look at this, right, if we have the dollar being very, very strong because of a fundamental, the Fed is hiking, and you have the euro here that is fundamentally weaker relative to the dollar. Okay, when you pair up, for example, a currency of euro dollar, okay, you're gonna get a very clear sense of direction. Okay, where euro is weak, okay, and the dollar is strong, so you have what we call a diverging policy. Okay, one is strong, one is weak. You get a very clear trend, a very clear direction. Okay, so if euro is weak and dollar is strong, then this as a ratio, as a pair, would likely drop. Okay, how to understand this is you look at it from a ratio perspective, right? If you look at euro versus the dollar, okay, you can also write it in terms of this. Euro is the numerator and then dollar is the denominator, right? And you're looking at the ratio. So if euro is weak, okay, and dollar is strong, okay, so if you put it in terms of like numbers, right, numerator drops, denominator increase, then as a whole, this ratio here would actually drop. You get it, right? So this is how you can look for opportunities from a fundamental point of view. Okay, same thing today. If you pair currency that has yen in it, right, you know that the yen is weak. So if you find a stronger currency like maybe the dollar, okay, dollar yen would have a very clear sense of direction. Okay, let me just very quickly bring out the chart to kind of show you, okay, what I mean on that. Give me a second over here, yeah. Let me bring out my chart. Okay, let me show you this. You should be able to see the chart over here, right? So let's take a look at euro dollar. If you take a look at where the year started, okay, 2022, right? This year itself, okay, that's where that's the beginning of this year. You can see the euro dollar has been falling overall in a very clear trend, okay, in terms of direction is down since the start of the year, okay, and we are here right now today, right? So why is that the case? It's actually through fundamental, you understand, right? Euro is weak, the dollar is strong, and therefore there's a very clear sense of direction. Okay, the other one that I mentioned is dollar yen, right? So if you take a look at the start of the year, 2022 is somewhere there, okay, and you get a very clear sense of direction. Why? Because the Fed is hiking, the dollar is fundamentally strong, the yen is still not hiking, right? Bank of Japan is still not hiking yet, so the yen is fundamentally weaker as compared to the dollar, and therefore the dollar yen rises very, very clearly. Okay, so from here you start to realize, oh, fundamental is actually very, very good to help you establish what we call directional bias, which means it helps to pinpoint, do you want to focus on buy, do you want to focus on sell? Okay, so that's the strength of fundamental. However, the weakness of fundamental is you do not know when to get in and which price to get in, right? Based on fundamental itself, it's like, okay, I want to buy, but where to buy, where to get in? Fundamental can't really tell you that, okay? And that's where technical comes in, okay? And that's where technical comes in, right? As I mentioned, every method to approach the market has its strengths and weaknesses, okay? So technical analysis over here, it's where we have some assumptions, right? There are many ways to approach technical, but today I'm going to share with you one of the most effective way that I'm using right now, okay? And it's effective means that you don't need to overcomplicate the process. It's effective means that with just this simple technique, you can actually start applying it and start identifying opportunities to trade, okay? So the assumptions of technical analysis is that the market discounts everything. Now, what this means is that you need to have this assumption in order for technical analysis to work, right? The market discount everything means that whatever you see on the price chart are basically efficient in a way, right? Which means the market efficiency theory means what you see on the price chart is what it is, okay? To put it very crudely, okay? The second assumption here is price move in trends and counter trends, which is to me a little bit like, yeah, no brainer, right? It's either going to be trending or counter trend, like whatever, okay? So not that important. But the last assumption is what I want to highlight, okay? Price action is repetitive and certain patterns tends to reoccur again and again and again. Now, this is the highlight that I wanted to get you to understand, okay? When we look at technical charts, we are essentially looking at a certain patterns that repeat itself over and over again. And as a trader, we are basically capitalizing on the patterns repeating itself, okay? So think of it this way, right? If today, when you, for example, day-to-day basis, right, you realize that, oh, every maybe, you know, somewhere between August to September, it tends to rain more frequent as compared to other months of the year, okay? And you realize, oh, every year this seems to happen, right? This is the case. August, September, it tends to rain a little bit more. So when you start to identify this pattern, you start to adapt to it, right? So in next year, maybe in August, right? You now be aware that okay, it tends to rain a little bit more. Then what will you do? You know, maybe when you go out, you tend to bring your umbrella with you. Okay, maybe August you realize that it rains a little bit more. You don't plan your holiday, your outdoor events on August. Okay, so this is patterns that occur on a daily basis, and maybe subconsciously, right, we are already implementing this principle where this is the pattern that is happening year in, year out, and therefore in the future you make adjustment according to this pattern, right? And in trading is essentially this principle as well. If you're looking at technical analysis, okay, you're looking and identifying a certain patterns that repeat itself, and in the future when you start to identify, oh, this pattern I know, right, it has a certain tendency of developing like that, you can start to capitalize on it, make money out of it. Okay, so that's the thing that I want you to know. Okay, so as we approach technical analysis, there are many different ways, right? Some traders, they focus a lot on indicators, right? There are definitely a lot of indicators out there. Some traders focus on price action, like as I mentioned, patterns. Okay, and there are of course some traders combining both. So there's no such thing as like which one is the right answer, which is better. Okay, as I always cover, each of them has its own benefit. Okay, so for indicators, for those of you who are more interested into it, right? Today we won't go into like indicators on that segment, okay? But for those of you interested in it, generally we kind of categorize the indicators into trend, right? So there are indicators to help you identify trend, direction. Then there's a second category, what we call oscillators. Usually this category of indicators help you to identify what we call overbought, oversold condition. Okay, in short, I call them extreme zone. Okay, so when the market goes into an extreme zone, there's a high tendency of a reversal, right? So indicators on oscillators tends to tell you that. Okay, and then you have indicators to help you measure momentum of the market or volatility, right? Volatility simply means how much the market is moving in a given period of time. Okay, so when you study indicators, have this big picture in mind as well. Okay, why? Because you don't want to have too many indicators telling you the same thing. It defeats the purpose. It's going to complicate the process. It's going to confuse you, right? So if you are looking at indicators, you just need maybe one indicator to tell you the trend, one indicator to tell you in terms of oscillation, and one indicator to tell you the momentum, and that's about it. Okay, so common indicators over here to give you some example, right? If today you want to use an indicator to identify the trend or the direction, the common one is called moving averages, okay, in short MA. Oscillators here to find extreme zone. Most of the time we use RSI, relative strength index, or MACD, moving average convergence and divergence. To measure momentum, okay, the common indicator that trader use is Bollinger Band, in short BB. Okay, it's not only this, but these are some of the common examples to illustrate over here for those of you who are interested. Okay, I do have some indicator series that I put up on my YouTube channel. For those of you interested, you can spend some time to go through them. Every video I talk a little bit about different indicators, how to use it, what does it measure, how to include that as part of your strategy if you're interested in it. Okay, I think just go and search the indicator series on my YouTube channel. You can find that. Okay, so we're not going to go too in depth into that today because today's focus is more on patterns. Okay, and this is to me, I think, more effective for me, and therefore I want to share this with you guys. Okay, so patterns over here, if you look at any chart, okay, there are generally three types of moves that we can identify: strong impulse move, slow corrective moves, or what I call a try hard. Okay, I'll show you some visual aspect of that so you can put that description to the visual image of that chart. Okay, now understand that doesn't matter what instrument you're looking at. It can be FX, it can be CFDs, it can be indices, it can be commodities. As long as there's a chart, okay, you can apply this principle. Okay, and that's the beauty of technical analysis. Okay, doesn't matter what time frame you're looking at as well. Okay, it can be on a 5-minute chart, it can be a 15-minute chart, it can be hourly, daily chart, or even on a weekly chart. The principles apply. Okay, so we have these three categories, yeah, strong impulse, slow corrective, or what we call a try hard. Now, let's take a look at the example on a visual scale, okay? Now, what I've highlighted over here are moves that are impulsive, which I call strong move, right? So you see here, visually, you can identify it, right? From this low to this high, the market went up pretty fast. From this high to this low, the market came down relatively fast as well. Okay, same for this move here, down, move up, move down here, move down here, move down here. Now, when we mean fast or impulsive, we are talking about relative terms, right? So if you look at the comparison of it, okay, let's compare this move here versus this move here, right? You can see very clearly this is very, very big, very fast. The one here that I'm circling right now is slow. It's not really going anywhere and it's slow, right? So you can visually differentiate what we call by strong impulsive move, right? Same thing over here, this move to the downside compared to this. Obviously, this is faster, right? I think quite obvious, right? This move down versus this move down, this is also more impulsive. Okay, so that's the idea of it, right? That's the first category of market movement that you need to be familiar with. Okay, now second is the slow corrective move. Okay, so this is actually the same chart, right? I'm just dissecting it on different parts to show you what I mean by impulse, slow, and then the try hard. Okay, so over here you can see this are slow move. Okay, it's going up, but it's not going up very fast compared to what? Compared to this move down, right? This move up is slow, not really a lot. Okay, look at this here as well. It came down very fast, it went up, but slow. Okay, essentially sideways, right? This as well. Okay, so sideways and corrective move, they have one characteristic on the chart. It tends to go up, down, up, down, up, down, up, down. It takes a very long time to develop, but essentially it's not going anywhere. Okay, so if you take a look at this here, it goes up, come down, go up, come down, but it's not going anywhere. Same, down, up, but it's not going anywhere, right? This one here as well, it went up, it came down, it went up, it came down, it went up, it came down. You know, basically we call this overlapping move, up and down, up and down, up and down, but it doesn't really go much. Okay, so these are corrective moves. This is the second category that you want to be aware of. Okay, so three types of movement in the chart, right? This is the second. Now the third is what we call try hard. Okay, the term try hard means that it lacks the energy and momentum, but it's still trying to go in a certain direction. Okay, so for example, case in point example here, right? This move from a low, it went up initially very fast. After that, it continued to go higher, but it's slowing down, it's struggling. Okay, and therefore this is what we call a try hard. Okay, same example over here, you see this initial move that is very strong, and then it continued to climb higher but slow down a lot. Okay, so that's what we call a try hard. This one here, it came down initially very fast, and then it keeps going down but slowed down significantly, right? So this portion again, we call it a try hard. Okay, there's another term I call, we term it as well to just communicate among traders. I call it a crawl pattern, right? So why a crawl? It basically crawl, right? Like you're trying, no energy, but you still want to go, and therefore you're crawling. Okay, it's just basically a description of it. Okay, now from a technical chart, once you're able to visually identify these three moves, okay, it's actually very powerful. Okay, why is because you can start to see the chart as puzzle piece. Okay, you can actually forecast the next move, right? So what I mean by that is, if today you have three pieces of a puzzle, essentially what you can do is you can start to play mix and match. Okay, and when you're able to mix and match and you start to identify, oh, there's a certain probability of things happening with consistency, then you as a trader, you can capitalize on it, right? You can make money out of that. Okay, so this one over here, the idea is, as traders, what we want to do is we want to go and learn this pattern, digest this pattern, we understand that, okay, there's a very good chance, a very high probability when we see this pattern, the next thing is going to happen, right? And maybe 60 to 70% of time that happens. Okay, so in the future, when we see something similar, then we know, oh, there's a 60 to 70% chance it's going to repeat itself. And as traders, what we do, we take the trade, okay, because there's a 60 to 70% probability we're going to get it right. Okay, so that's the whole idea of technical analysis. Okay, so what we are talking about over here are patterns. Okay, so I'm going to share with you a couple of patterns over here, and it's all built up from the understanding of impulsive move, corrective move, and the try-hard, or we call a crawl. Okay, so if you take a look at this, right, same chart, I just make it into a line. Can you identify certain patterns that tend to repeat itself? Okay, give you a couple of seconds, right? Just look at it, train your eyes to start to see patterns that tends to repeat itself. Okay, now firstly, okay, can you see that every time we get a try hard, what does it happen? The market tends to reverse. Can see that, right? So it's a try hard to the upside, therefore it reverses down. This one here as well is a try hard to the upside and it reverses down. This one is not so obvious, okay? You can even count it as a failed one, a try hard to the downside, but it didn't really reverse much, maybe a little bit, okay? So maybe out of, in terms of probability, we have 3 try hards, 2 of them work out, okay? So 2 out of 3, right? Not bad, the probability, okay? It's more than 50%. You're gonna make money if you trade it, okay? So that's what I mean by identifying the pattern that tends to repeat itself. Now, another one. Every time you see an impulsive move followed by a corrective one, the direction is likely going to go is the same direction as the impulse, right? So this one came down, it does a correction, it went down further. Okay, here as well, it came down very sharp, it does a correction, and then it continued to the downside. Okay, so what is this pattern? When you see an impulse followed by a correction, you know there's a high chance the next move is going to move lower as well. Okay, so same thing here. You get a very strong move, you get a correction here, you get a corrective move. What do you expect next? You're gonna expect this to come down. Okay, so obviously on this chart, on this example, we have 2 of such example, and both of them work out. 2 out of 2. Okay, obviously it's not gonna be 100%, but in this example here, we get 100%. So far, follow me. Okay, so that's what pattern really means here. Then you have that impulsive move only, right? So we call that a V shape, right? So what is a V shape? This one here. Okay, so when you see a V shape, basically just impulses after another, there's no edge, there's no probability. So when you see something like that, you don't trade. Okay, so from this simple example of this chart, right, you realize that it's not that difficult to dissect and understand a technical chart. Once you understand the fundamentals, building block of patterns, okay? And that's what I wanted to get you to achieve, right, in today's sharing session, okay? So same thing, you can apply on any instruments as long as there's a chart, any time frame, cool? Okay, so this one here, we talk about it, right? You see this drop, you see a correction, you see an impulse, you see a correction, you expect the next move to continue, right? Same thing over here, right? So that's the pattern, okay? When you see a try hard or a crawl, it tends to reverse. Same thing over here, a try hard, a crawl, it tends to reverse. Obviously, this one did not work out, okay? Then of course, we have the V shape, or, basically we just get a strong impulse move, right? When you see that, don't trade it because you don't have an extra advantage over the market. Okay, now, so if you start to put that together, right, we can simplify it into 3 combinations, right? Mix and match. So we have the first combination of an impulse plus correction, which means you get an impulsive move. Following that, you get a corrective move, a slow sideways move. When you see this, obviously you have a trade opportunity. Okay, when you see an impulse plus a crawl, which is the try hard, you also have an opportunity because that's a reversal setup. And then you have the just impulse, which basically V shape, you don't touch it. Okay, so when you start to understand all this and you start to apply it into your trading, what it helps you to do is directional bias. It tells you what direction you want to be focusing on. If you get an impulse plus a correction, okay, we're gonna expect that the next move is gonna follow the direction of that previous impulse, right? So if the impulse is up, you get a correction, you expect the next move is gonna go up as well, and then you're gonna be focusing on the buy trade opportunity, right? If you get an impulse plus a crawl, a try hard, it's a reversal setup, right? So it's going to be the opposite direction of the impulse. If the impulse is up, you get a crawl, you expect it to reverse, which means come down. Okay, and if you only see impulse, no edge, remain neutral, you don't trade. Okay, so give you some visual example, right? This is what we mean by impulse then correction, right? You have a strong move up, you have a correction here. We expect the next move to continue upside. Okay, follow, right? I think that's quite straightforward already. So same thing, you have dual direction. Okay, if you have a strong move down, you get a sideways move, you expect this to come down. Okay, if you get a crawl, okay, to the upside, you expect a reversal to the downside. If you get a crawl to the downside, you expect a reversal to the upside. Okay, if you get V shape, don't trade. Okay, so these are just the three patterns you need. Okay, you don't need to complicate the whole process, right? So now let's apply this a little bit into some practice. Okay, the tip and the hint for you guys, right, is just focus on the most recent development, right? So always ask yourself this question: if the market price is here right now, ask yourself, what does this looks like? How is the market developing? Obviously, this looks a little bit more on the choppy side, right? Sideways correction. Okay, so you have a correction piece over here. Okay, and then what about the previous one? Ask yourself again, right? How is the market developing? Is it fast or is it slow? So obviously, relative to this here, this is fast. Okay, so what pattern do we have? We had a strong move down, we have a sideways move. When we see this, we know high chance this would likely continue to the downside, right? So this is actually a pattern of this, which we know we want to be selling it because we have a high chance of winning if we sell it. Okay, and just show you what happened next. This is the market. It came down. Okay, again, it's not going to work out 100% all the time. If it is, everyone will be making huge profits from the market, but it's about probability. Okay, you get about 60 to 70% chance that will happen. Okay, give you more example. Okay, so if you take a look at this here, again, the tip and the trick over here is focus on what's happening. Price is here. Ask yourself, how does this look like to you? Fast, slow, what is the development? What type of category? Impulse, correction, or try hard, or we call it a crop, right? So you realize that yes, it's going up, but seems to be struggling a bit, right? It goes down, goes up a little bit, comes down a little bit, goes up a little bit, comes down a little bit, goes up. It's like not so clear cut, not so direct. Okay, it looks a bit more like try hard. The previous was a strong move up. So what is this category? You get a strong push, you get a crawl. You know there's a good chance this will reverse. Okay, so this looks like what pattern? This one here. Okay, so which direction are you going to be focusing on? You're going to be focusing on the sell trade. Okay, and this is what happened next in the market, right? It reverses and comes down. Cool. Now, even within this, you can see we have a strong push, we have a sideways move. Okay, and this here is also a pattern, continue downside. Okay, so again, it tends to repeat itself over and over again. Okay, more example. Look at this. I just want to highlight, right? Some charts are obvious, some charts are not that obvious. Okay, obviously it comes with experience. Okay, but this one here is, it should be clear as well, right? Ask yourself, how is the market developing here, right? Obviously very slow, right? Up and down, up and down, up and down. It's not really going anywhere. The previous one is fast. So what pattern do we have? We have an impulse, we have a correction. We do expect this to go up, right? Very easy right now. Okay, so what's going to happen next? We see this. What happened next? Whoops, the market just shoot up. Okay, now I just want to very quickly bring your attention to some live chart example. Okay, let me clear this off. Okay, now just to show you maybe some of the clearer ones. Okay, when we talk about euro dollar, okay, maybe I'll go to a daily chart. Okay, it's not, some charts are not as clear. So what you want to do as a trader, right, especially if you're new to trading, find those that are the clearest to you. Okay, so now if you take a look at this here, before this entire drop recently, okay, okay, it's loading a bit. Okay, you can actually, maybe I'll go down back to the forward time frame, right? You can actually look at the chart and ask yourself, okay, how is this entire piece developing? Okay, maybe not very fast. Yes, it's going up, but you know, it's taking very, very long to develop. Okay, as compared to what? As compared to this move down, right? Can you see this is super fast, this is slow? So what pattern is this? It's actually a strong move, a correction. Which direction are you going to anticipate? Down. Okay, and that's what exactly happened, right? The market actually then came down very strong. Okay, it comes in different sizes, right? Can you see this move here as well? A strong move down, a slow move up, impulse correction, down move, right? So it's generally the same, right? It's just the size of it is different. This is smaller, this is bigger, but the pattern principle is the same. Okay, give you another some more example, right, to just play along with it for right now. Okay, so let me just clear this off. Let's go to this pattern. Okay, now these are not trades that I'm suggesting you to trade. It's just giving you example, right, for today's purposes. Okay, look at this development here on this chart, right, and ask yourself, how is price developing? Okay, you realize that yes, it's coming down, but a lot of overlap, right? It came down, it went up, it came down, it went up, you know, very slow. Previously, what was the move? Very fast to the upside, right? So when you put these two pieces together, what combination do you get? Impulse, correction, what direction do you expect? Upside. Okay, so obviously right now we won't know for sure if it's going to go up, but I know high probability, 60 to 70%, this would likely happen. Okay, so I would then look out for buy opportunity. Okay, now how do you get involved in a buy trade? There are many ways to execute a trade. Okay, obviously I won't have like the luxury of time to talk about every fine details in today's sharing. Okay, but I'll just drop you a very simple technique. Okay, we call it a breakout. What this means is today, if I've already established a direction that I want to focus, now in this case here, just now we talked about it, it's a potential buy. Obviously, I can look for entry at the bottom here to buy it. At the same time, I can wait for a breakout. What this means is I wait for it to reverse and break a certain price point, then I get it. Okay, again, different methods has its strengths and weaknesses, but for simplistic purposes, we're gonna cover breakout today. Okay, so for example, if today I want to buy this, okay, what is the key level to identify? At this scale here, we can see we have this little high, right? So we have this little high here, so I can actually use a horizontal line, put it down, and the price point on this level here is somewhere around 161.80. Okay, so what this means is that I already established a direction I want to be focusing on based on the pattern, which is buy. I've identified the recent high that's recently established, which is 161.80. So what I can do is I can wait for price to maybe start to confirm it wants to go up, you know, it starts to bounce back up, it breaks that 161.80, then I get in and execute a buy trade. Okay, so this is a very simple technique called breakout trading. Okay, you can start to add layers of it to help you increase, you know, further increase your probability. But again, as I mentioned, I don't have the luxury of time today to really go into full details, right? Because I really want to cover that spectrum of topics to give you a wide understanding of what currency trading really is. Okay, so I hope you understand that part as well. Okay, yeah, so that's on the technical analysis portion. Cool. It's not as easy as it seems, to be honest. Okay, a lot of time I get feedback is that, oh, okay, I understand, I get it, I see it very clearly, But then when the participants go and apply this principle on themselves on the chart, the feedback I always get is I'm lost. Where to start? Things like that. I know how that feels, right? Because I've been in your shoe before now. I mean, every trader walked through almost a similar journey, right? We went through the process of learning, right? So I want to just encourage you that yes, at the start, it might take more effort from your side to actually implement and apply all these principles that we cover. But the more you practice, the more experience you get, the easier it becomes. That's how things works, right? It can seem easy right now, okay, on how I do it, because I've been doing this like many years, okay. So I just want to let you know it's common, okay. If you find it a little bit, I would say, effortful, where you need to put in more effort, because you might sit in today's sharing and say that, whoa, Kar Yong is able to do it without much difficulty, right? With so easily, so quickly he can do it. It's not an overnight thing, okay? I just want you to know, and as long as you keep practicing, you gain that experience. Eventually, everyone can do it. Okay, so I hope that message is clear. Okay, so that's on the technical, right? And the last portion, we have a little bit more time over here before I open up for Q&A. I want to talk about managing your risk, okay? Because as traders, to me, this is the most important element, okay? You can have a lot of fanciful strategies, very complex strategy, or you can have a very simplified strategy. All of them works, okay? But at the end of the day, whether you're going to be consistently making money sustainably as a trader boils down to how you manage your risk. Okay, so risk management is definitely one of the things that I always emphasize to fellow traders. Okay, now when we talk about risk management, there are a few terminologies that I think you definitely need to be aware of and you need to know. Okay, one is called margin trading. Then you need to understand what leverage is, what is margin level, what is drawdown. Okay, now I'm gonna dive into it, what they mean to you. Okay, now margin trading, basically, some people might see it or misunderstood it as it's risky, it's dangerous, but you can also see it from a side where, because of today's technology, we are able to do margin trading, and therefore you don't need a lot of capital. Okay, now imagine without margin trading today, you want to trade the financial market, and the minimum capital you need is like 100,000. Okay, how many of us would start trading with 100,000? Even if you have, you be feeling very fearful, right? Like 100,000 you put in, what's gonna happen? Okay, it's huge, right? In terms of the risk. So the beauty of today's technology is we have margin trading, where we are being offered what we call leverage. I'll explain a little bit in a while. So you don't need too much capital and you can already get started. Okay. So margin trading is basically, you use a small amount of capital as collateral. Okay. And you put this margin, you put this capital as collateral with your broker, and you are able to then trade with a bigger position size in the market. You're able to trade in the market. Okay. So think of it as a good thing. Okay. It's actually an advantage. Now, why some people say it's dangerous is because they don't fully understand risk management. Okay, they don't go and implement risk management, and therefore it becomes very risky, because you can use small capital to trade very big, right? So if you don't understand and implement risk management, you then start to think of it as what? Gambling. Okay, you can put in a little bit of money, trade a lot. So what you do, you put more money in it, you trade even bigger, right? So that's where people say it's risky. Okay, so this is often tied to the term leverage, which just I mentioned briefly as well. Okay, so let me explain what is leverage, right? Some common misconception that traders would have is, high leverage is bad. Okay, and then you have another school of thoughts that people will say high leverage is good. Okay, the higher the better. I want to find a broker that offers me very high leverage. Okay, usually people who kind of like have this kind of understanding, I call it misconception. It's not the full picture. They probably don't really understand that. Okay, so over here, I want you to think of leverage as a tool. Okay, leverage basically allows you to trade a big position with a small capital. Okay, so if you misuse it, right, you go and abuse leverage, it can be dangerous. But at the same time, if you fully understand leverage and you know how to maximize it, you realize that during some opportunity, sometimes, right, maybe you don't have a lot of capital, but you realize that, well, this trade is, you're very confident about it, there's a very high probability of happening. You can actually leverage on this thing called leverage. Okay, you can utilize leverage to increase your position size so that you can potentially make more out of it. Okay, but of course your risk can be bigger too. Okay, so it's a tool, because if today you as a trader, you know how to control this, you can actually put that to your advantage. Okay, so over here, leverage itself does not directly tie into risk. Okay, how you manage risk ultimately decides whether it's going to be risky or not. Okay, a 50 times leverage, if you don't control risk, can also be very risky. A 200 times leverage, if you know how to control it, it can be very safe. Okay, so understand that leverage is not risk. Okay, leverage is just a tool. So over here, most often it comes in the form of like 50 times, 100 times, 200 times. Okay, so what this means is, just very simply for math purposes, right? If today you have a times 100 leverage, and you want to execute a position size of equivalent to 10,000, what you need is just $100 collateral. Okay, which means your capital, you need to kind of use it as margin. Okay, roughly is about $100, right? So with $100, you can trade 10,000 position. 10,000 worth of position, right? So you get the idea of it. So you can use a small amount of money to trade a bigger position size. Okay, so same thing over here. If your leverage is higher, then the margin, the capital required is actually smaller. Okay, so that's the whole idea of it. It's not that complicated, right? So leverage means that. Okay, so the idea here is, if I put that in the context of FX, okay, the smallest position size you can look into for FX market is 0.01 lot, okay, which is equivalent to about 10,000 units, right? And for simplistic purposes, if today 1 unit is equivalent to $1, and you want to trade 1,000 units, it means that you roughly need about $1,000, right? Without leverage. That's what it means. Now, if today you have a leverage of 100 times, then you don't need $1,000. All you need is $10 for you to execute a position and maintain and open the position that's worth $1,000. That's what it means. Okay, so think of it as, today if your capital is small, then of course you'll be utilizing more leverage. But if your capital is huge, you realize that leverage is not that important anymore. Okay, so this $10, we have a name to that, right? We call it margin required, right? You need $10 to open that position, and therefore $10 becomes your margin requirement. Okay, now with all that, start to understand a little bit of, like, what is leverage, what is margin trading. There's this term here that you also need to be aware of. Is called margin level. Okay, margin level is actually a very quick way to check whether your account is safe, or in other words, it's like your health checkup. Okay, very quickly, okay, is your account suffering from high blood pressure? Okay, is your account in high cholesterol state, right? Similar kind of idea. Okay, so margin level over here, it has a formula, but you don't need to go and memorize it. Okay, you can always refer to your platform, whether it's MT4 or MT5. It will tell you what's your current margin level. Okay, but for knowledge purposes, this is the formula: equity over use margin multiplied by 100%. Okay, the higher your margin level, the safer your account is, and of course, the lower the margin level, the more risky it's become, right? So this is a picture taken from a MT4 platform, right? So you can see over here, margin level as of this example is 19,000%, so very safe, very high, right? So these are some of the example of calculation, right? If your capital is at 1,000, you open a trade with a margin of $10, then your margin level will be 1,000 divided by 10 multiplied by 100%, you get 10,000%. Okay, so you don't need to go and calculate manually, but just understand it. Okay, so over here, in terms of margin call, okay, what this means to you, right? So just now we talked about margin level, right? Brokers nowadays would have this safety net called margin call, right? This safety net is to prevent your account from going into negative territory, which means when you go into negative, you owe the broker money, right? So the broker knows you're not going to repay them, so they have this safety net, okay, and we call it margin call. And the whole idea here is every broker would have a different margin call level, but what it means is that if your margin level drops to a certain extent, to a certain level, where the broker determined that, okay, that's the level of margin call, it will automatically close the biggest losing trade for you in order to prevent your account from going into negative territory. Okay, give you an example over here. If you have 4 trades running, okay, one of it is euro dollar, you're losing $100, pound dollar, you're making a little bit of profit of $40, dollar yen, you make about $15 profit, and then you have one big loss here, dollar Canadian, losing about $230. Now, in the event that you did not do your risk management properly, the margin level drops towards a margin call level, the broker would then force close the dollar cap for you without getting your acknowledgement, meaning it's really just, okay, you do not have enough margin level, we are going to close that dollar cap for you. Okay, and that's how it's going to happen, right? And if your margin continue to drop and you don't maintain that, they auto close off the next biggest losing trade for you as well. Okay, so that's the whole idea of what we call margin call. Okay, so some margin level guidelines. Okay, if today your margin level is above 1,000, 5,000, I think that's safe, it's okay. Okay, but if your margin level starts to go between 500% to 1,000, you need to start taking note of your risk management processes. Okay, and if today your margin level starts to drop below 500%, that's a very high chance and of risk that you might get margin call. Okay, so this is just a quick health check, right? But the whole idea here is if today you manage your risk well, you won't be worrying about this. Okay, good. So last term here to talk about is drawdown. Okay, now what is drawdown is basically a measurement of how much you have lost in terms of your equity, right? I'm pretty sure in this challenge, you might have certain prerequisite, right, or requirements that you need to ensure to be qualified, right, for the final winner. Okay, and drawdown over here is one of the best way to measure how much risk, or I would say how much loss that this account actually suffered during the duration of trading. Okay, so if give you an example over here, right, if your highest capital or equity is at 10,000 and your current account is at 8,000, which means you actually took some losses. Okay, you lose $2,000, right? So 2,000 out of 10,000 is actually 20%, which means your drawdown right now is 20%. Okay, so you need to be aware of this figure and you want to determine what's your maximum comfortable drawdown. Now this is different for every individual, right? Some people would say that I'm comfortable risking or losing a total of 20%. Some people would say I'm only comfortable with 10%. Some traders would say I'm okay with 50%. Okay, you need to determine your maximum comfortable drawdown. Now, why is that important? Because if today you don't know what's your maximum risk, you can't control risk management. Okay, you need to first determine what's your maximum risk, and then from there you start to control it. So give you a very quick formula that you can work with. Now, if today your maximum drawdown that you're comfortable with, for example, okay, is, let me change the color first, right, is 20%. Okay, you want to use this as a guideline. You use 20%, divide by 20. Okay, so this number of 20 means you're giving yourself 20 chance to trade in the market. Okay, and when you divide this by 20, you get what? 1%, right? So this 1% is actually the risk that you're gonna use to trade every time you take a trade. Okay, and what this translates is that if today you take 1% for every trade that you take, and let's say you risk 1% per trade, you lose one trade, you lose another trade, you lose another trade. You need to lose 20 trades consecutively to hit your maximum drawdown, which is quite difficult, to be honest. Okay, because why? I mean consecutively means one after another, you keep losing 20 times in a row. It's not an easy feat, right? I mean, I've actually put this up as a challenge before to some traders. I say, go and try and lose consecutively 20 times with a proper strategy. Okay, and if you are able to do it, you also realize that, oh, actually you have a winning formula, because if you can consistently lose 20 times, you just need to flip whatever strategy that you have and do the opposite. You end up having a winning formula. Okay, so if you realize, right, by sharing with you this principle, you realize that to bust an account, to lose an account with proper risk management, is not an easy feat. Okay, and most of the time people lose their account or lose a lot of money is really because of risk management. Okay, so understand the importance of that and why I keep emphasizing it. Okay, yeah, good. So that's the drawdown aspect. Okay, so over here, we'll move on into like how to put all this together, how to develop your trade plan, right? Then I'll open up for Q&A for you guys. Okay, so checklists and steps to do. Okay, by putting all this that we've covered so far in today's sharing. Okay, first, you need to identify your risk profile, as I mentioned. Okay, before even you start to develop the strategy, how to gonna trade, how you're gonna analyze the market. First thing first, you need to know what is your maximum risk that you're willing to put. Okay, so take this challenge that you guys are participating very seriously as well, right? Take it as if like this is your life account, it's real money. Okay, go and plan it out in terms of like your risk. Okay. Then you want to then establish what type of analysis or strategy that you're going to use, right? So in today's sharing, we kind of cover the fundamental aspect of analysis. We cover the technical analysis portion as well based on patterns. Okay, we did cover a bit, introduce to you guys about technical indicators. This part here is where you probably need a little bit of exploration. Okay, try out different ways, find out which you are comfortable, which one you're aligned with, and then you want to establish that, right? So you need to be clear. Are you going to be combining fundamental or technical, or are you just going to base on technical? If you're combining fundamental and technical, how much percentage of weightage do you give to fundamental? How much of a weightage do you give to technical? Which one comes first? Which one is more important, right? You need to have that kind of clarity. Okay, and then from there, that's where you need to then decide, okay, so based on my risk, based on my analysis and strategy, how much am I risking per trade when I execute my trade, when I enter the market? Okay, so that's how, you know, in terms of step by step, how you do it. Okay, and then last but not least, of course, you need to track. Okay, every trade you take is good to do some form of tracking plus journaling, right? Journaling is the whole idea of putting your whole thought process into words, okay, into text. Now, why is this important? Because as a trader, you need to evolve, you need to improve, okay? And this whole process here is an ongoing one, okay? It's not like today you set it and then that's it, it's gonna work forever, okay? As you evolve as an individual, as a trader, your strategy tends to evolve together with you, okay? So that's why tracking and journaling helps in that process to help you review where are the areas of improvement. Maybe this part you don't really like it, this part it works very well, keep doing it, right? So you need to know all this aspect. Cool. So for every trade you take, you want to identify the direction. Okay, so this kind of give you an idea, like every method or strategy that you use, eventually you need to handle this few elements. Direction, is it buy, is it sell, is it neutral? Okay, then you need to have the technique, right, to identify the best time, or I would say quote unquote ideal time to execute your trade. Now if you want to buy, do you buy now, do you buy tomorrow, do you buy at this price, do you buy at a lower price, which price to get it? Okay, so that's about timing. Okay, now if today you want to make money from trading, or you want to profit from that trade, you need to get both the direction and timing right. Okay? So in other words, for any type of analysis or strategy that you develop, you want to have components within your analysis and strategy that answer these two questions: which direction, what time to get involved in it. Okay, so hopefully that helps. And last but not least, of course, you want to manage your risks. Okay, so that's this part here is really, I can't give you a plan, I can't give you a strategy because every trader is different, right? But what I can provide you over here is a framework to help you craft your personalized strategy. Okay, because these are elements that no matter what strategy you use, you need to have them within it. Okay, so I hope that helps. So far so good, yeah. And then of course track and journal. Good. So analysis approach, today we talk about fundamental, right? It has a strength, basically giving you a bigger picture in terms of direction where you want to look up for, buy or sell. Okay, but as I mentioned, the weakness on this is the timing of it. Okay, and then we talk about technical analysis, right, which is great in details. It can give you a sense of direction. It can tell you where to get in, where to get out. That's the beauty of technical analysis, right? So you can either use TA, technical analysis, as a standalone, or you can combine with fundamental. But it's very difficult for you to use fundamental as standalone. Okay, because the weakness of fundamental is really timing, right? Just like I mentioned, you need direction, you need a time. Fundamental doesn't really have that time. Cool. And of course, risk management over here, you want to establish your entry, your stop. You go and calculate, based on this entry, based on this stop, what is the lot size, the position size that you should be trading, okay, depending on your risk profile. Okay, and of course, understanding pips over here. These are basic understanding, which today, if you head over to this website called bappips.com, it's freely available, right? So I don't want to spend too much time covering on, I think, theories or concepts that you can find readily available online, right? Because that would waste your valuable time, and you waste this opportunity where I can share with you something that you probably can't find online. So things like this, understanding pips, you do a simple Google search, there are tons of information out there, right? And these are very straightforward concepts that I don't want to spend too much time on, right? So the idea of this is basically it's a measurement of how much price move, right? So if a currency pair move from 1.2100 to 1.2101, the fourth decimal place is 1 pip. Okay, if it's Japanese, then we look at second decimal. And of course, you want to go and calculate that and relate that to lot size, right? So pips is one terminology I think you can easily find what it means. Lot size is the same thing over here, is basically how big, how small. Okay, the smallest position you trade in FX is 0.01, and if you put that into pip, it roughly means 10 cents. Okay, if you trade 0.1, then 1 pip is about $1, right? Pip is the movement of price. Okay, and one lot here is about $10, right? So based on this understanding, the pips is how much your stop loss is, what is the width of your stop loss in terms of pips. Then you need to know your risk, which is how much money you're willing to risk, and then you go and calculate a position size. So it's actually just a mathematical formula behind it. Okay, so for example, right, if you're trading euro dollar with a stop loss of 100 pips and your risk per trade is $100, then your position size, based on math calculation, it should be not more than 0.1 lot. Okay, why? Because if you trade 0.1 lot, every pip is $1. Your stop loss is 100 pips. Every pip is $1. 100 pips is $100, and that's your maximum risk per trade. Okay, so that's the idea behind it, right? Cool. So just understand this is the math behind risk management. Okay. So today over here, to sum up, right, the sharing over here, and then I'll probably have about like 10 minutes for Q&A before I need to pass the time back to Phillip Nova over here. I want to give you that whole picture. Okay, and this is actually an illustration of a building, right? And I want you to see that in trading is quite similar to that, okay, where every building that you want to construct, it always starts with the foundation, okay, because that's like the most important block. Okay, in trading is actually the same. Okay, and what is this foundation that we're referring to? Is your mindset, is your psychology, is your mentality. Okay, if today you come into trading thinking that is a get rich quick solution, you can make money fast, it's easy money, you're having a wrong mentality, right? Which means that your foundation is already wrong, it's shaky. Then whatever you build on top, very quickly it will collapse, right? But today, if you come in with the right mindset, like trading is a proper skill set, it takes time, it takes effort to build up, but once you build up the skill set, it's gonna last forever. That kind of approach, that kind of mentality and mindset, it's right? It's proper, right? Because you're coming in looking at it not as a get rich quick scheme, right? So when you have that strong foundation, whatever you start to build on top, it becomes stable. Okay, so have in mind on that, right? And in terms of the 4 pillars here that I term it, is basically what builds a comprehensive understanding and strategy to trade the market. Okay, so we have the macro, or I call it fundamental as well. Okay, so kind of interchangeable. The term here, macro, fundamental, more or less the same. We have the technical analysis portion, we have the risk management portion. Of course, today we don't really have that time to go into the sentiment portion of things. But if you're looking at FX market, these 4 pillars will give you a very holistic understanding of the market. Okay, and then at the end of the day, that's where you build up your roof, okay, to top it all, right? And that's where I call the strategy component. Okay, so now why I share with you this drawing is also because I want you to see we start with the bottom up, okay, and not top down here, right? A lot of times traders, when they get involved in the market, they say, I want to learn a strategy, I want to learn a strategy. Okay, without the proper process, I can give you a very profitable strategy, but it will not work for you if you don't have the proper understanding. Okay, so that's why the proper process over here is build your foundation, understand the different pillars of the market, then you construct your strategy. Okay, that flow, doing that accordingly, will be more sustainable and more helpful for you guys as a trader. Okay, so hopefully I want to share this because I strongly believe, right, at the end, after this challenge, there will be some of you, okay, that will take this very seriously and want to transit into maybe making trading as a potential career. Okay, so I just want to give you that I would say roadmap, okay, the framework to help you as much as you can when you approach the market. Okay, hopefully that helps so far. Good. Okay, so with that, I think I'll open up the session for Q&A. I'm sure that there are some questions that you might have. Okay, so let me know. You can write down your questions, type it in now, and then I'll be able to answer your questions. Okay, we have about like 10 minutes before I need to pass the time back to Phillip Nova. Okay, so within this 10 minutes, I'll do my very best to answer as many questions as you guys have. Hopefully you guys have questions, right? I'm pretty sure I have, all right? Okay, so do type your questions in, let me know. Okay, what maybe certain aspect is not clear, or perhaps there are certain aspect that you'd like to clarify. Just feel free to ask. Any?
Shit, I cannot mute. Hi.
Yep.
I have trouble. We can hear you. Can you hear me?
Yeah, can
Hi.
hear you.
Testing. You can hear me? Oh, sorry. There's some glitches in my phone. So here I am, stepping in to read out some questions that our attendees have posted to you. So
Alright.
the first one is, could you just quickly go through the 3 broad categories of patterns again?
Sorry, 3 broad categories of patterns.
Yes, that's right.
Okay. Let me quickly bring you to the slides, right? Okay. So the patterns over here is this tree. If you want, you can quickly take a screenshot or take a photo of this. Okay, and then I'll just flash through the different illustration of that, right? So the first category is impulse, and then you combine it with a correction, right? So we have a trade setup whenever we see this. The second category is a crawl. So same thing, we get a setup when we see this. It's a reversal one. And the last one is basically when we see just impulses of V shapes, then we don't trade it, right? So over here, this is the illustration of it, right? So if you see a push up followed by correction, so basically this is what we call impulse correction, right? Impulse, very fast move, and then slow. Okay, so this one here, we'll expect this to go up, all right? And then of course, vice versa, this is where we had a very strong move down, then we have a sideways move, correction, then we expect it to go down. So this is the first category. Now the second category over here is the crawl, okay, where we get a strong move and then it continues to go in the direction of that, but it's slow. Okay, so this tells me lack of energy, potential reversal. Okay, so same thing over here, we get the up one and then the down one, right? So there's second category. Okay, and the third one is basically just V shapes where you don't trade, right? When you see this, you don't trade the market. Okay, so that's the three categories of patterns that to me it's like the simplest way of identifying pattern, but at the same time very effective. Okay, so it's like what we call a building blocks, right? It's like the foundation of technical analysis chart patterns. Yeah. Good. Any other question?
Hi, Kar Yong. Sorry, we are having some technical issues.
Okay, sorry, we were having some technical issues. So right now, I should be able to read you the questions already.
Yeah.
Hold on. So there's another question. For TA, what's the time frame to use?
All right. Now, if you guys are okay, again, it depends on what's the style of trading that you want to approach, right? For me, I'm more towards a swing style of trader. So I'm looking at somewhere around 4-hour time frame to a daily chart time frame. But of course, because if you're applying swing trading to a competition like this, okay, you might not have a lot of trades opportunity because it might take a longer time for a setup to develop. Okay, so for example, if you're looking at a trading challenge, you might want to maybe go down on the lower time frame on the 1-hour chart, okay, so that you have more opportunities that you can actually take, okay, and have that trading activity ongoing, right? But at the end of the day, there is no like which time frame works best because every time frame works quite similarly. That's how technical analysis work. Okay, it's more of the lower the time frame you go, the more I would say the quicker you need to make your trading decision, right? Because if you look at 1-minute chart, then every minute counts. If I look at a 4-hour chart, then almost every 4 hour, then it matters to me, right? So I have more time to analyze, I have more time to make a decision. Whereas compared to someone who is trading maybe at a 5-minute chart, a 1-minute chart, things move very quickly within that time frame. You need to make trading decisions very fast as well. Okay. So as a someone who is new, right, and trying to pick up trading, my suggestion is always don't go below 1 hour because things can get very messy quickly, and you might make a lot of unnecessary mistakes if you are put into an environment where you are pressured to make decision fast. Okay, so hopefully that answer the question.
Yes, thanks, Kar Yong. So there are quite a few questions. let me read out another one for you. One of our participants asked, how long does it take for you to control your emotions while trading, and how do you actually control it?
Oh, okay. I couldn't exactly pinpoint when I start to have that. I wouldn't even say full control, but I would say more control over the emotions. I can't really pinpoint exactly which part of my trading journey, but I would say it's actually a journey that is you need to constantly work on, right? And it's not something that I would say you just decide to learn it and then you acquire the skill set, right? It's something like a muscle memory, right? Same thing like if today you go to the gym, okay, it's not an overnight thing. It's not like, oh, today you hit the gym and then tomorrow you become buff, okay? You need to continuously do it in order to train your muscle, right? So managing emotions are also a muscle memory where you need to consistently work on it. And the whole idea of that is we all have emotions, right? A lot of people think that we remove emotions from trading. No, you don't do that, right? The whole idea here is you will still feel disappointed when you have a loss. That's common, right? Because you lose money. Nobody likes that, right? You feel happy and excited when you make money. Common, right? Because we make money, we are happy. Okay? But the differentiation between someone who is able to control and manage their emotions versus someone who is driven by emotion is the fact of being self-aware. Okay, so if I put it in that flow, I think the first stage is you need to be self-aware before you even manage and control, right? Self-awareness basically means that you now can acknowledge how you are feeling. Okay, so if you're feeling angry, you can actually acknowledge the fact that yes, you maybe are feeling angry, right? If you're happy, you're excited, you acknowledge the fact. Okay, that kind of acknowledgement is already what we call self-awareness, because you actually are aware how you're feeling. Okay, now when you're able to achieve that, then the next stage here is to have the ability to say stop, and or I would say not stop, but pause and think about what you want to do next, right? So for example, now let's say I acknowledge that I'm feeling very excited. Okay, then before you make any decision next, you're able to pause and say, okay, now I'm being excited. Should I do this or should I make this decision, right? So that little split second of pause and think is that management aspect. Okay, because as I mentioned, all of us has emotion, right? If I make a winning trade, I'm going to be happy, but before I take the next trade, I actually have this split second of, yeah, I'm excited. When I take this next trade, should I go bigger? Maybe not, right? So you have that kind of like consciousness that stops yourself. Okay, so that is, again, it's a very intangible aspect of trading, but it's very important, because if today you don't have the ability of doing it, okay, you realize that emotions will start to take control over your decision. Okay, again, as I mentioned, it's not an overnight thing. You might maybe fall into the trap of letting your emotions dictate your decisions, maybe at the starting phase, right? Greed might control your decision, or fear might control your decision. But as you review your trading, right, evaluate your results, these are areas in which you can start to be aware of, start to put a little bit more emphasis into practicing that, right? As I mentioned, it's a muscle memory, it's not an overnight thing. Yeah, so hopefully that gives you an idea of how to work on it. Okay, it's not something where, you know, like technical analysis that's like this step, this step, this step you follow, right? Emotions, that's really isn't that simple. Everyone is different, but that's how I learn it, that's how I do it. So hopefully sharing with you that kind of framework might help. Yeah, hopefully that answered that question.
All right. Thanks, Kar Yong. So I think due to the interest of time, we would cover one more. So this seems like it is a bit more related to the market trends. So one of our participants is asking, what do you think of the China's central bank and MAS? So basically asking like the Chinese yuan and Singapore dollars. And where do you think the trend is going?
Okay. Now, first part here, when we talk about China, it's a very complicated market to deal with, because in my words, I call it Xi Jinping's decision, right? Today he feels happy, he wants to do certain things. Basically, China will then do it. Okay, so it becomes very single person decision in a way because he has really huge power in doing that, and therefore if you are touching anything related to China in terms of financials instrument, right? So be it Chinese stocks, be it Chinese indices, or in this case, currencies, right? You need to be aware that there's a certain risk where you can't really foresee what's going to happen, right? Because it can easily flip. One day is bullish, the next day is very bearish, depending on what Xi Jinping decides to do. Okay, so that's something that is very, very difficult for traders and investors to really kind of forecast the direction of China assets, whether it's stocks, indices, or currency. Okay, so from that perspective, I can share with you, like, my personal view is, number one, I don't touch anything related to that, right? I don't touch Chinese investment. I definitely don't touch Chinese yuan. Okay, and just, I'm not sure if you guys are also aware that China's economy or banking system is starting to crack. It started with the Evergrande collapse. The housing bubble in China is starting to crack, and that starts to lead towards the banking system starting to crack too. Okay, now how serious is that going to be? Is China gonna eventually, have a big mess? I can't say whether it's gonna happen. Okay, but signs of it cracking is already there. Okay, so will the Chinese yuan eventually become very bearish or even collapse? There might be the possibility if the housing bubble busts. Okay, the banking system fail, the Chinese yuan can really collapse. Okay, and then on the other side, of course, we talk about Singapore dollars. Overall, I can share with you the fundamental of SGD is stable. Now, it's not going to be very exciting trading the Singapore dollar, because Singapore has this monetary policy bandwidth, right, where they need to ensure that it cannot be too strong, it cannot be too weak. You need to maintain the bandwidth because of the uniqueness of Singapore economy. It deals a lot with imports and export, right? And you can't have your currency too strong. It will hurt your export. You can't have your currency too weak. It will hurt your import. So it's not going to be very exciting trading the Singapore dollar because it usually maintains within a bandwidth. Okay, but the fundamental of that is going to be strong, which means that you can expect long-term Singapore dollar to continue strengthen overall. Okay, so that's my view on two different countries' perspective related to their currency as well. So if you put that together, for me, though I don't trade them like that, I don't trade the yuan, I don't trade the Singapore dollar, but to me, if you're looking at yuan versus SGD, there's a good chance yuan will potentially devalue. And then, of course, Singapore dollar here has a good chance of strengthening over the years, right? So hopefully that can give you some insights and different perspective.
All right. Thank you very much for sharing, Kar Yong. And dear participants, we do see your questions, but due to the interest of time, we will respond to your questions in a follow-up email after this session. Okay, so do be rest assured that your questions will be answered. All right, for now, the time that all of you have been waiting for is the sharing of an exclusive perk that is extended to you. Okay, so would you give me a while for me to share my screen, and I would therefore introduce my colleague, Mr. Bear, who would be sharing about this with you. Mr. Bear, are you here?
Hey, Junkit, can you hear me?
Yes, we can hear you. Please go ahead to share the good news with our participants here.
Great. Thanks, Junkit. First of all, well done all of you here. You have made it to this exclusive perks session where you get to see what we offer as this Phillip Nova YIP Young Investors Program. Um, Before we move on, I would really love to say, w- um, coming to this course with this sharing session with Kar Yong has always been inspiring. And today, I've also seemingly been inspired the same way I've attended this multiple times, and I hope you have learned something as well. So I really want to thank Mr. Kar Yong here for his time, and not just because of this. I would like to highlight one part of this talk about risk management. I've dealt with multiple clients, many traders every day who have many years of experience, and a lot of them may not even have the proper fundamentals that Kar Yong have spoken about just now. So we really hope that you can continue learning even after this sharing, and what we can offer you as little bit from the Phillip Nova side is this full sponsorship of his trading course because remember the foundation with the four pillars that Ankaring talked about. This course will specifically go through that. And not only with the step-by-step video lessons, you get an exclusive connection with this coach, Mr. Ankaring himself and his team. So I'm sure you have more questions to ask when you learn more things. And not just that, last but not least, you have this access to this student community. In other words, like a trading community where you get to share ideas and you get to learn something new from one another. So this course is actually worth in the market rate of close to 100 US dollars. And thank you to Mr. Kar Yong as well that he's able to give us a very good rate at a much discounted than the market, and that will be covered by Phillip Nova. So I'm going to share to you the next slide so that you can understand what are the steps are required for all of you to get this full sponsorship of this trading course. Okay, so if you have your computer with you or your phone with you, make sure to print screen on this slide or take a screenshot, or better, scan this QR code directly here. So the first step is for you to open a live account. It is free of charge, by the way, and you need to make one trade because for you to really understand and to be serious in trading, you need to put your practice into real life. All right. So first off, you need to scan this, open account. It will be very easy. Just follow the steps. Later then, when you sign up for the trading course via a link that we will send out through the email, all you need to do is register for the course and send the receipt to us. You can say, hi, dear Bear, I'm super trader Max something, and then, yep, and then we'll reimburse you the full amount. So I'll give you some more time for you to scan this code. Before I move on to the last section, Mr. Kar Yong, are you still there?
Yes, I'm still here.
Great. Would you like to add anything on your course?
Yeah. So basically, on top of just the training videos that we provide, there are of course I've also included toolkits, checklists to help you in the process as well. So basically, when we talk, for example, when we talk about developing your trade plan, how to get started, we have templates within there to give you a guideline as to how to craft out your personalized trade plan. When we talk about fundamental analysis, there are some tools that I've included to help you analyze the market from a fundamental perspective as well. So yeah, in that training is not something that is just theory based, but very much focused on how do we take those principles and apply them in the actual market. So along the way, those are the tools that I've developed to assist the traders to do that as well. Yeah, so that's just to add on what you're getting within this training.
Thank you so much. Thank you. Yes, I cannot agree more with learning and continue learning in this process of to become a better trader. Um, so I hope all of you have managed to take a snapshot or is already on the process of filling in your details to open an account. Um, if you have not, fret not. After this session, we will be sending you all the official email for you to be able to access these links and get more information on this one. So with that, thank you so much for participating. I'll pass the floor back to Junkit.
All right, thank you, Bear and Kar Yong. So at this point, I think that we have come to the end of today's session. We would give you a gentle reminder to also tune in tomorrow at 4:50 p.m., where I think it is also an equally important part where we share with you how you can use the Philip MT5 trading platform that you'll be actually using during the trading challenge. Okay, so being familiar with the trading platform itself, I would say, gives you a higher winning chance in the trading challenge. All right, so I think that is all. Be rest assured that your questions asked will be answered tomorrow. And also, we look forward to seeing you tomorrow afternoon. Okay, so I think if that is all, I wish everyone have a great dinner, great rest, recharge yourself before you join us again tomorrow. All the best, everyone. Goodbye.